Markets are at all-time highs with investors optimistic we'll avoid a recession. So how do we do it? Well, investors will be primarily focused on rate cuts, labor markets, consumer confidence, and corporate outlooks. Inflation is important too, but we feel investors are more comfortable with the recent inflation progress and thus less of a concern outside of a big negative surprise. So first, rate cuts. The Fed sharply raised rates to combat the surging inflation from a couple years ago. Increasing rates slows the economy, and cutting rates is typically the opposite, boosting the economy. Rate cuts started at last month's Fed meeting, with investor expectations for more this year and next. The next meeting is in November, with markets hoping for quick and sizable cuts. Next, labor markets. An unfortunate side effect of slowing the economy is impact to the jobs market. A weak labor market can imply companies are pessimistic and less willing to invest in growth, as well as impacting consumers with less job prospects. While not that weak from a historical standpoint, you've probably noticed the jobs market getting a little tougher over the past couple of years. Investors will look towards weekly jobless claims and jobs reports to show that the weaker jobs market will start to stabilize. However, if the jobs market continues to weaken, avoiding a recession will be much harder, especially with this impact on consumer confidence. Consumer spending drives a large portion of the economy. It has been incredibly resilient despite inflation, rate hikes, a weakening jobs market, and waning confidence. Investors are hoping consumers continue to power through, though, until the economy turns. They'll be monitoring spending data like retail sales, as well as consumer confidence surveys. As an outsized portion of spend and sentiment gauge, holiday spending will be also a big focus. And finally, corporate outlooks. Businesses play a crucial role in the economy through hiring, spending, and investing. Corporate earnings will be a big focus as investors evaluate sentiment from both Q4 guidance and early 2025 outlooks. They'll be hoping for positive commentary on consumer demand, spending plans, and overall sentiment. While there are still some wildcards, particularly the escalating global tension, markets are banking on improving economic data across labor markets, consumer confidence, and business outlooks to avoid a recession. Investors will pay close attention to even the smallest changes to gauge whether a soft landing is on track. A soft landing is a delicate balancing act, which is why it's often referred to as a Goldilocks soft landing. Not too cold, not too hot, but just right.